Folks, we have some problems. We have some major problems out there we need to address, but you know where the problems are not? Sofi stock up 7+% here today. We're now up about 16% on the stock, up $3,300. What's going on with Sofi? Why is the stock starting to explode to the upside? We'll speak about that, where that stock's headed. PayPal stock keeps moving and grooving, up another about 4% here today. What's going on with PayPal? More big news came out here today in regards to PayPal. It seems like every week right now we're getting great news in regards to PayPal. This stock is up 17% for me now, $33,000. It's over 10x'd in the past month. S&P 500. There's a massive divergence going on between PayPal and the market. The honest company, are we set to get out of the gulag on this one? Is it actually going to happen? Are we getting out of the gulag before the end of the year? The gulag, if you didn't know, is under $5. If you're under $5, you're in the gulag, right? And you're trying to come back to life. Are we getting out of there this year? We're going to speak about that. I'm going to address that. Nvidia. What did I tell you guys is going to happen? I told you guys 4 to 7% this one's going to go down. Went down 6% here today. Wall Street was expecting 10% plus. I heard somebody say something interesting. They said, this isn't fair. How does Tesla trade at a higher forward P than Nvidia? Tesla numbers have been nothing but a disappointment the past year. Nvidia numbers have been nothing but stellar, and yet Nvidia trades at a much lower multiple than Tesla. They said Palantir. How does Palantir deserve to trade at a higher valuation than Nvidia when it comes to forward P and these sorts of things? This isn't fair. We're going to address that. Life isn't fair. But there's a serious reason why these stocks trade here and why Nvidia trades there. We'll speak about that in this video. Ulta Beauty. What the flip is going on with this stock? It is crashing more. People thought Warren Buffett put the bottom in regards to this stock. No. Okay, what the heck's going on there? Lululemon just reported trick-or-treat quarter. You gotta look deep into the details here. Don't be tricked by what's going on with the stock price. We'll speak about that in this video. Celsius is down to $37. It seems like every day the headline is Dow reaches a new all-time high. And yet Celsius seems like it just reaches a new low, another 52-week low for the stock, 37. I'm flirting with buying this one. When am I gonna step up and buy this dang stock? When is it going to happen? Just wait on it. I'm going to tell you exact price in this video, what I'm going to start buying Celsius stock at. Appreciate y'all joining me as always. Thank you so much for being here. I need 2 things from you. 2 things, that's it. Make sure you subscribe to the channel. Are you subscribed? If not, hit the subscribe button. 2, smash a like for this video. That's all I need from you. I appreciate you. If you want to take stock market investing a lot more serious, get access to my private stock group, wealth group, 1000xstocks.com. Pin comment down there. Click on that at the end of today's video. Fill in an application. See if we can get you in there next week. So, Sofi, right off the bat. Whoo, baby. We got big stuff happening. Supreme Court keeps hold on student loan relief plan in place. The U.S. Supreme Court declined to reinstate President Joe Biden's most recent plan to forgive student loan debt for millions of borrowers, instead letting lawsuits in lower courts play out. The justices refused to take up an administration request to lift a hold on the federal appeals court placed on the program in a lawsuit by Republican-led states. Now, Biden's been trying to get this passed, basically, forgive a lot of student loan debt. They have been able to forgive a lot. As of July, the Biden administration has forgiven $168 billion in student loan debt, mostly through a program that applies to borrowers who work in certain public service jobs. Now, some people love this as far as, the whole student debt forgiveness thing as far as college goes. Some people hate it. People that love it generally are ones that have a lot of debt and might work in lower paying jobs, right? Those folks might be looking at it and they're like, I'm $40,000 in debt with student loan debt, or $80,000 or $120,000, whatever, right? And so they look at this, they're like, we want it through. The bottom line in regards to Sofi is Sofi got screwed for several years when people didn't have to repay the student loan debt, right? Sofi had a bunch of, had given a lot of loans over the years, and this was something that very negatively affected Sofi's business. And so the Supreme Court says, no, this is not right. You can't be doing this, right? No. Additionally, there's a lot more momentum building because of Sofi's latest numbers. So you tack on today the decision by the Supreme Court here, which is definitely the best situation for Sofi imaginable, right? But additionally here, this gentleman writes, the kind of summary here, Sofi shows resilience with a 9% return driven by strong loan demand and a slightly bullish technical outlook. Sofi's diversified platform improved loan performance and tight credit risk management underpin the long-term growth. strong Q2 2024 financials, product innovation, and a 58% assets under management growth highlight SoFi's operational efficiency and potential for continued expansion. SoFi's Q3 2024 growth reflects an expected 18 to 22% increase in adjusted net revenues, driven by financial services and customer acquisition. You're starting to get a lot more people over to this bullish side and feeling very good about the future of SoFi, given the growth rates this company's been putting up in a very challenging environment. Let's not kid ourselves. It's been a very challenging environment, and yet SoFi's been able to put up very good numbers and been able to keep loan losses and those sorts of things in a very good state. And so I think between the Supreme Court and just the excitement around SoFi in general, I think this is a very good thing for the stock price of SoFi moving forward. Now, also additionally, somebody said something interesting. I posted something about SoFi on X earlier today, and they said, why is it that SoFi specifically is so popular on X? And I think this is a great question, right? Because you look at SoFi in general. Is SoFi a popular stock? Do they talk about SoFi on CNBC and Bloomberg all the time? No. On YouTube, is SoFi a super popular stock? No. But on X specifically, SoFi is such a popular stock. And you're going to ask why. I'll tell you exactly why, okay? Listen. On X, usually communities form, retail, more investor-related communities will form around stocks when they think they have a leg up against Wall Street. Like they found a stock ahead of time, essentially. And you'll see these communities build out there on a platform like X, right? And they'll build out before really anybody ever catches wind. And so, for instance, Tesla's been a huge community on X way before Tesla became a super famous stock in the stock market. It became one of the Mag 7s and all those sorts of things. Way before that, Tesla was already popping on X. It was already a very popular stock. Retail got ahead of Wall Street in understanding where Tesla's future was going, what was going to happen with the business model, the future electrification, all those sorts of things, right? You know what? Another great example of a stock like that? Palantir. Palantir's had a strong community on X for years now at this point in time. That community was very built way before this latest run in Palantir stock, I can tell you that. Palantir was always a very popular stock. So if you're wondering why a stock like SoFi is so popular in there, it's because there's a lot of retail investors who really believe in SoFi's future and really believe SoFi is going to be a $30, $50, $100 stock in the future. And they're buying those shares under $10 here today, and they believe they're getting a steal deal. We'll see if this is the next Palantir. We'll see if this is the next Tesla. But there is some writing on the wall that it could be, right? And so it is a financial, though. It is a bank at the end of the day. So you got to, there's a risk level with those. But it might end up being in the next Palantir. It might end up being in the next Tesla before it's all said and done. That leads me to speak about PayPal. PayPal, this stock's starting to move and groove. What's going on here? Another big announcement here today. PayPal expands strategic partnership with Fiserv. That's what I call them. Okay, I don't know if that's the proper way you pronounce a company, but that's why I call them. Okay, Fiserv, to streamline checkout experience in the United States. PayPal today announced an expansion of the global strategic partnership with Fiserv, which will streamline how merchant clients of Fiserv enable PayPal experiences for their customers, building on a long-standing partnership between the two companies covering several products and services for millions of businesses. The expanded relationship simplifies how that company's clients enable PayPal, Venmo, and related services and provides these businesses with a simple connection point to Fastlane by PayPal. Fastlane by PayPal, we're hearing more and more talk about this, okay, to accelerate guest checkout flows in the United States. We're excited to deepen our collaboration with Fiserv and extend our innovative products and solutions to a broader audience, says the Executive Vice President and General Manager of Large Enterprise and Merchant Platforms Group of PayPal. Holy smokes. Alex, Chris, you might have to shorten that individual's title. Frank's title is a little extreme, okay? This partnership reinforces our commitment to driving excellence in checkout convenience by partnering with a leading payment services provider and e-commerce platforms. Phenomenal. And this comes just after last week, PayPal's Fastlane product to be offered on Adyen's platform as well, right, which was a big announcement. So here we are back-to-back weeks with major announcements, with major players in this space. And as a PayPal shareholder, this is what you wanted to see for the longest time. It seemed like prior to Alex Chris joining this company, it seemed like PayPal was just so slow moving. And you looked at PayPal as a business and you're like, oh my gosh, there's so much freaking potential here. You own PayPal, you own Venmo, you own Braintree, you have all this technology, you have this massive workforce. There's so much potential. And it just seemed like the company just moved at a snail's pace. And now all of a sudden we're seeing Alex Chris is taking these great properties and just like fast tracking everything. This is what we've wanted to see as PayPal shareholders, and this is what we're starting to see. This gentleman, I thought, commented perfect. He says, I think the market doesn't fully understand this new partnership with Adyen and Fiserv. They need Fastlane because the higher conversion for their customer merchants, and because these merchants, the 430 million PayPal users, are really valuable. PayPal is a great turnaround story. PayPal's Fastlane is quickly becoming a game changer in the payments processing industry, and it's easy to see why. With PayPal's massive user base of 430 million users, Fastlane leverages the company's deep data pool to offer a seamless one-click checkout experience that significantly boosts conversion rates. And this is what I've been talking to you guys about. One of the Amazon's genius in so many ways. One of the most genius things they adopted many years ago was what? One payment, one touch checkout experience, right? Where one button, you hit it, and the thing was bought, sent to your house. It remembers your credit card, your shipping information, everything like that. Amazon figured that out years ago and how to make that tech happen. But the problem is to get that same tech to all businesses, so all businesses have that, you need like a middleman who's like that great tech provider that could do that. PayPal's becoming that company, right? That can make this happen, which is phenomenal. Now, up to a 50% higher conversion than non-Fastlane users, which is huge, right? And that's why these companies are going to have to use this product, because it's either you use this or you make less money. What would you like to do? Make more money or make less money? Well, if you know anything about running a business, you would like to make more money than less money. So you better use Fastlane. This is huge for PayPal, obviously. And the most beautiful thing about PayPal, the most beautiful thing maybe of it all, is how cheap the stock still is. Even after this most recent move, even after significantly outperforming the S&P 500 very recently, the stock is still dirt cheap. A 16 forward P on the stock? Come on, man. With this sort of growth rates that this company's going to be looking at, and now the way they're positioning themselves, the way I'm watching PayPal start to position themselves, you know what company it reminds me of? Visa. Oh my gosh, this is starting to remind me of Visa, like in such a massive way. Visa is so well entrenched with merchants and with the consumer, right? Between, like it seems like everywhere offers Visa. And obviously, if you ever looked at your debit cards or credit cards, a lot of them are Visa, right? They obviously, MasterCard's another big player, but Visa is so interconnected into the payment space. And I'm watching PayPal expand, and I'm watching the moves they're making, and I'm like, they're going to end up entrenching themselves so deep, like Visa's entrenched in the market, in my personal opinion. And that's what we're going to see play out. And that's going to be very interesting to see what that does for Visa's, let's call it valuation over the coming years, and what that does for PayPal's valuation. Because Visa usually trades at, you go on 1000xstocks.com, check out Visa's valuation, right? It usually trades very, very rich compared to something like a PayPal on a forward P basis. And it might actually have much less growth in future years than something like a PayPal. So this should be very, very interesting. Now, honest, could we get out of the gulag before the end of this year, right? Stock's up 200+% in the past year, $4.35 here today. Could we get out of the gulag? Well, here's the thing, okay? I believe that if Carla comes in, Carla and Barton and the whole team, if they come in this next quarter and they beat on earnings per share and revenue again, we're going 5+. They're 4 for 4. 4 for 4, this management team is since they got brought in, right? They could go 5 for 5. And so as long as she comes in and beats another EPS and beats another revenue target, we're going 5+. We're out of the gulag, and I don't think we're ever coming back. Once we get out of that dang gulag. And so I think it's looking pretty good. Now, prior to Carla obviously joining the team, Honest was a disaster. I just got to call it the way it is, right? And it's not like an opinion, it's just facts. Like missed. I mean, 6 straight quarters of earnings per share miss. 6 straight quarters of EPS miss. You can't do that as a CEO and keep a job. You can't even if you were to miss half your quarters, that would be a disaster. 6 straight quarters? I mean, that's historically bad performance. And so Carla's got Wall Street starting to get her back. And you know why? Wall Street wants to see you come in. They want to see you beat numbers, right? Investors don't want to be in a situation where they're unconfident. They want to feel like every quarter you come in, you take care of business, you beat your revenue, you beat your earnings per share. The game of Wall Street. It's important, man. It's important how the business financials are being run, but also the game of Wall Street. You can't come in and miss, or they will send you down to $1, which is where Honest stock went, right? It was incredible, which I understand. Like, they deserve to go down to $1, right? Bankruptcy was on the table. They missed 6 straight quarters on EPS. Like, they deserve to go down to $1. That was embarrassing, just to be quite frank. But those days are long gone now. So we go 5 for 5. We're going to 5+, baby. Now, if I look at EPS, obviously, whenever a company is about to report their next earnings, which Honest will probably report in, I would say, November, it's important to understand it's not just about the quarter they're about to report, but the future quarter as well, because they usually give guidance. I look at those EPS numbers. I think those are beatable. I think there's a good probability they're going to come in with either flat EPS or potentially even profits, so positive EPS. And so I believe these EPS numbers here are very beatable, very beatable. That's what I'm feeling very confident. Revenue growth, I don't expect any fireworks there. I expect roughly in line or maybe slight beats. I'm not expecting the fireworks. This is what I think is going to get people excited, is I think they're going to come in with very nice EPS beats, and then we're going 5+. And I don't think we're ever coming back once that essentially happens. Now, as far as where the stock goes longer term, I think we're going to $10 to $20 on the stock. And here's why. And I think that's going to happen over 2025, 2026. If we look here, right, trailing 12-month price to sales ratio on Honest is about 1.2. It's about 4.7 for Procter & Gamble and about 2.3, 2.4 for Kimberly-Clark, right? Those are the most natural comps for Honest. You can't really comp them on a PE ratio because Honest is just starting to flip over to profitability, where Procter & Gamble and Kimberly-Clark have been profitable for a long time, right? So you've got to really compare them on a price to sales ratio basis. And so if we're talking about a 4x on the price to sales ratio to go from Honest where we're at to Procter & Gamble, right? And about a 2x in Kimberly-Clark. So I believe we're going to go to $10 just getting up to the price to sales ratio here of like a Kimberly-Clark. And keep in mind, Honest has way better growth rates, revenue and earnings per share than Kimberly-Clark, way better, right? And so at the end of the day, I think it should honestly command a much higher price to sales ratio than a Kimberly-Clark. And then we're talking about a 4x of where Procter & Gamble's at. So this stock would need to go like $16, somewhere around there, to get it to a price to sales ratio roughly in line with a Procter & Gamble. So there's significant upside, not only this year still left, as long as Carly and team keeps executing. Like, all of a sudden they drop the ball and like they start missing every quarter, like that's a whole different ball game. But as long as they keep doing what they've been doing, executing on this business model, like you can see how this stock goes to 5 to 10 to 15 to 20, and it happens, quicker. Let's just say in a rather quick amount of time, right? Now, some people are frustrated out there. Some people are frustrated, right? I get it. They look at Nvidia and they say, how, after such a great earnings, right? I graded that income statement. What did I grade it yesterday on the channel? It was an A+. A+, right? An A+ income statement, and the stock goes down. And people are frustrated. How does this happen? Such a bunch of crap, right? And then they're looking and they're like, look at Tesla's reporting such crap numbers, and look at the forward P on that stock. And Palantir's at a 90. How do they deserve a 90 when Nvidia's been growing way faster than Palantir, right? They get all, this isn't fair. You've got to understand there's a lot of dynamics at play. And we'll take these apart. We'll take it apart. Palantir and Nvidia, right? We'll take it apart. So, Nvidia, you've got to understand, okay? This company is a cyclical company. It's a cyclical company. I have it right here, okay? They're in a cyclical industry. Semiconductors is cyclical. And until you get off of just selling hardware chips, you're always going to be considered a cyclical company. Apple finally got kind of taken out of the cyclical space and started commanding a much higher multiple when what happened? Their services revenue started to come in because people started to say, okay, this is more than just selling hardware. It's more than just a cyclical iPhone cycle now. We know that revenue is going to be there quarter in, quarter out. The massive services is their second biggest business now. It's huge for that, right? Nvidia doesn't have that yet. So if you look at Nvidia, this is just over the past 10, 12 years or so. Look at this. The revenues went down here. The revenues went down here. And right here, they almost went down. I mean, like almost went down. So you've had 3 time periods where basically the revenue went down on a year-over-year basis. That's the sign of a cyclical company. And so you're likely looking, 2025 revenues are going to be great for Nvidia in my opinion, but you could be looking at revenue that flatlines or goes down in 2026. That's a sign of a cyclical company. Now, if you look at somebody like a Palantir, it's not that at all. Look at Palantir's revenue year after year after year. It goes up and 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 it goes up, right? You don't have to worry about like, ooh, what's the cycle going to be? When are the revenues going to go negative? You don't have to worry about that. Palantir just grows and grows and grows and grows and grows. Let's take it a step further though, because that's on a year over year basis. We could take it a step further. This is on a quarter over quarter basis. This is a whole other level. Every single quarter, on a quarter over quarter basis, on a sequential basis, Palantir grows revenues. They don't ever go backwards. That's historic, right? That's special. That's a special SaaS-related type company, right? Look at this. Every quarter, they grow revenue, even in bad times for the company, even in time periods where people are very disappointed with, Palantir's revenue growth and all that. Even in those bad, dark times, the company would still grow revenue quarter after quarter after quarter. And that allows you to sleep very well at night. There's not the stress of an Nvidia stock or an AMD or some of those that are more chip related that it's like, how long is this cycle? Because that's what everybody's figuring out in regards to Nvidia. How long is this cycle going to last? We got another 18 months here, or is it more like 12 months? Or is it more like 6 months? Or is it more like 24 months, right? That's what everybody's trying to figure out. We know that this crazy AI demand is going to taper out, and then NVIDIA revenues will go flat or go down for a year or two. We know that's going to happen, right? And it's just a question of like, when does it happen? Is it 2026 or 2027 or 2028? Like that's an uncomfortable game. With Palantir, we don't have to worry about that. And so you're willing to pay a lot more for a company that just is going to keep growing quarter in, quarter out. You don't have to stress about when's the revenue going to go down, right? Cyclical companies, you have to deal with that stress. And that's a worry, and that ultimately commands lower valuations. Now, if NVIDIA can grow out their software business substantially over the next 5-10 years, they'll get taken out of being just a cyclical chip company, which then in turn will command a lot higher valuation in terms of PE basis, right? And so if you're wondering, how does NVIDIA grow to become a $10 trillion market cap someday, right? How does it do that? Which, if you're investing in NVIDIA at a $3 trillion market cap, you're probably hoping to grow to like a $6 trillion, $9 trillion, $10 trillion market cap, right? Because you want to double up, triple up your money for taking the risk you're taking in regards to a stock like that. Well, one, they need to continue to knock it out of the ballpark when it comes to the selling chips, right? And just keep coming out with better chips and better chips. That's not debatable, really. They're going to keep doing that as long as Jensen's there at least, right? But the other component is you have to start coming in with that revenue that people can count on quarter in, quarter out. That's non-chip related. That's software revenue. If they can get that over the next 5-10 years, then we could be talking about a company that could approach a $5 or a $10 trillion market cap. It could happen, but that's how you have to do it. And so you got to understand, they're not there today. And they're not going to be there tomorrow either. And so therefore, you're not going to command the sort of valuation that something like a Palantir will command as far as a forward P. Now, you look at something like ELF, somebody was like, what about ELF versus NVIDIA? Well, ELF is not cyclical. Their revenues might be really great at a particular time. They might be a little slower at a particular time. But at the end of the day, looking pretty is not cyclical. Doesn't matter what's going on in the market. People want to look pretty. They want to put their makeup on. And so ELF is that's opposite of a cyclical market. Like they're just going to put up their numbers. And you may say, Tesla's cyclical. I mean, at the end of the day, Tesla is what? Tesla is an automaker. That is the biggest business for Tesla by far and away. They sell automobiles. And automobile sales are what? Automobile sales are the definition of, a cyclical market, right? Well, here's the deal, okay? Tesla, if we think about Tesla for the next few years, 2025 through 2027, investors view Tesla at that particular time as going through a cycle very similar to what Nvidia has been going through 2023 through 2025, right? Nvidia 2023 through 2025 is going through the super cycle of their business model because of these AI chips, right? Everybody in the world knows that. People believe Tesla's going to go through a similar super cycle in their business model. It starts in 2025 and it goes through 2026 and 2027. No, just like Nvidia's business doesn't die after 2025, Tesla's business model doesn't die after 2027. It's just you have a certain time period of like a super cycle of growth ahead. And so people believe this super cycle of growth will be coming for Tesla. It'll be a 3-year super cycle. I believe there's a high probability the super cycle happens. And the reason is there's three core reasons why this is going to play out. One is Tesla's going to launch their more affordable vehicle, right? The under $30,000 vehicle. And that should go into production in 2025. That should be ultimately something that helps Tesla immensely. The autonomous taxi network, right? Which is a car coming to pick you up and kind of like an Uber and Lyft-like experience, but with no driver in the front seat. That is something that should take off. And then the third reason is Optimus, right? The robot that should be able to do a lot of things in factories and a lot of things in general, right? And Elon's already talking about doing some useful things in the Tesla factories here over the next few months. We'll see. Now, if I had to say, I say there's a high probability, right, that two of these are going to play out. Model 2 and autonomous taxi network, I think, are basically automatics. Those are going to play out, right? And I think you're going to start to see a lot of markets around the United States starting in 25 as we move into 26 and 27. They'll start adopting Teslas that basically will drive themselves around, right? And people will be able to get picked up by those vehicles. And the Model 2, there's no doubt in my mind that's coming out, and that's going to be huge for Tesla, right? And that's going to be huge around the globe for Tesla. That's the thing. It's not just like it's only big in the United States. Like that's going to be, I think they're going to do way more vehicles sold outside of the United States than inside the United States. I think the market's been craving a great under $30,000 new vehicle for the longest time. And I think we're finally going to get it from a company because we don't have that in the market today. Like a truly great, like people feel good when they get into it. They love the tech of the vehicle, right? It does the job and it's under 30K brand new. We've been craving that in the market, and I think that's going to happen, and I think it's going to be way bigger around international markets than it is actually in the United States. Autonomous taxi network, I believe that's playing out. Optimus is a question mark, right? It's a real question mark. I don't know. We'll see in regards to Optimus. But the moral of the story is Tesla's going to go through a major, major growth cycle from 2025 through 2027, and so that's why people are willing to pay up for that stock. That's why. You got to understand there's different dynamics at play. Nvidia is already going through their super cycle. So people have already, paid up for that. That's why Tesla stock's down 50% from its old highs, right? Nvidia stocks, very recently was at all-time highs. There's different things being priced in here. One stock's been chopped in half from where it used to be. The other stock went to the moon, literally, right? That's Nvidia. So you got to understand the dynamics at play here. You got to understand the games that Wall Street's playing and kind of how they're thinking. And this is a big game of chess. You got to understand how the game of chess is played, right? Speaking about chess, the chess game's going very bad for Ulta Beauty. The stock's down big after hours. What happened here? Is this a run out of situation? Okay, wow. Ulta Beauty has some problems. They really do. First off, it looks like they might have had some extra days in this quarter. It's a little confusing, but net sales, they were up, but like slightly up, like barely up year over year. Cost of sales was up pretty significantly for the company year over year, which means their gross profit did what? Went down. It fell. No bueno. No bueno when your gross profit's falling. General administrative expenses, they went up considerably. That's not good. When your revenue is like basically flatlining and your SG&A is going up substantially, no bueno. That was up about $44 million on a year-over-year basis. So your operating income is going to get destroyed, and sure enough, it did. They went down to $329 million of operating income versus $391 million in the same quarter last year. That was about 15.5% of revenue in the previous year period, now down to 12.9%. Look at net income. Net income fell to $252 million, 9.9% of revenue, versus $300 million, 11.9% of revenue in the same quarter last year. No bueno. I did the math for you guys. That's around 19%-ish down year over year. Oh, not good. Diluted EPS 530 versus 602. No bueno. No bueno. So when I look at Ulta here, I understand Buffett's been buying it. First off, we don't know if Warren Buffett's been buying it. Todd and Ted run money. It could have been Todd or Ted running money in buying this one, right? Ulta has some problems here, and I don't know if and when they get out of this, right? I don't know. The issue, what I'm thinking about right now is I'm thinking about e.l.f. is growing their business like 50% right now, right? And I'm thinking about Ulta's having trouble even growing their business right now. And I'm thinking about who's doing the business. And I'm thinking Walmart stealing market share. I'm thinking maybe Target stealing market share. Maybe Sephora, maybe MAC, maybe somebody like that. But at the end of the day, this is not good. This is not good for Ulta. And so You know, the valuation's gotten a lot more compelling in regards to Ulta, but the problem is, look at the bottom line's in free fall. It's in free fall and down 19%. It's a hard one to buy with net income going this bad. And remember, the unemployment rate is still very low. What happens if that picks up, guys? That's some food for thought in regards to that. So Ulta, nah, can't do it. Nope. Too many other opportunities. I'd rather own some strong brands like either an Elf or an Estee Lauder, owning Ulta right now. And you know who else could be taking market share? There was one other company, and this one's huge. You know who just came to mind? Amazon, right? I mean, at the end of the day, if you look at a product on Ulta and you look at that same product on Amazon, if Amazon beats a price, you gotta order on Amazon if it's the same exact product, right? At the end of the day, Ulta sells pretty much the same products that you could get anywhere else, right? You can get those products anywhere else. And so this is some food for thought here, guys. It's riskier than it actually looks. And that's kind of sad because Ulta's been a very great company over the years, no doubt about that. Lululemon is a trick-or-treat quarter. Okay, this one's a trick-or-treat in regards to this one. Now, it was interesting watching the stock price after hours. It was somebody who was pulling magic. That's all I'm going to say. A magician saved that stock after hours. Because that stock went straight down, and then I don't know how they did it. I was just watching it, and I'm like, who's doing a magic trick here? They somehow saved that stock price. I don't know if they'll be able to save it tomorrow in the actual open, but they saved it for now. That was interesting to see that play out. I'm like, maybe they're saving it just to re-short it and then tank it tomorrow. I don't know. It just was very fishy, extremely fishy. Now when it goes to Lululemon, it doesn't look that bad when you just look at the income statement. B plus here. Net revenues, almost 2.4 billion versus 2.2. Cost of goods sold, it was up for the company year over year by about $48 million, but it's not that much if your revenue's up, 170 million or so, or 160 million. So gross profit was up very nice for the company year over year. As a percent of revenue, gross profit went to 59.6%. Now, selling general administrative expenses, that's a little problem for the company, 871 versus 817. Income from operations, 540 mil versus 479 the same quarter last year. Other income, 17 mil in the plus versus 7 mil. That's really good to see that. I'm guessing interest income, probably. Net income, 392 million versus 341. And diluted EPS, 315 versus 268. So you might look at this and you might say, this looks great. Like this are very good at least. Maybe not great, but very good. So what's the problem with Lulu? I'll show you the problem. You gotta dig in these earnings reports. You gotta look a little deeper. I'll show you the problem. Look at this. So what we're looking at is comparable sales in the Americas region. Down 3%. Down 3% for the company on a year-over-year basis, right? Now, international looks great. International up 19%. That's phenomenal. So you may say, okay, America's only down 3, international up 19. What's the problem? Take a look at this. America's is by far and away the biggest region for the company. It's not even close. America's net revenue, $1.7 billion for the company. China mainland, 314, right? 314 mil. So 1.7 billion versus 314. Rest of world, $254 million versus $1.7 billion in Americas. So even if you add up China and the rest of the world, it's like a little teeny baby compared to the Americas side of the business. So if there's real systemic problems in the Americas region, right, in the Americas versus China mainland versus rest of the world, this is bad, guys. This is really bad. And since comp store sales are now going negative, there might be a systemic problem at Lulu, because this was thought that never be possible. Like Lulu reporting down comp store sales, comparable sales down 3%, 2% on a constant currency basis. Like, you would just think that was never possible because this company just grew to the moon, and then it's now going down. Like that's scary, right? Now I was in New York City back in June, right? What a picture I took there, right? That's what we call 1000X, baby. Let me put on a little better picture, okay? My wife and me. So I was in New York City a couple months ago, and it was interesting. New York City's always one of the, I would say, leaders in regards to kind of like fashion trends, right? LA can be that as well, New York City, and I understand those cities can get their hate, but at the end of the day, they do lead the fashion trends. And what's going on in those cities a lot of times is adopted throughout the rest of the United States. Whether people like it or not, it's just the way it is, okay? And so here's the deal. It was interesting being in New York City because my wife said, I'm hardly seeing anybody in yoga pants, right? Like Lululemon pants. And, you know, you go to most of the rest of the United States and it's like that's been the big trend. Like everybody's wearing yoga pants. And so there was a trend in New York City. There was a trend in Los Angeles, in more of the hip cities, right? The ones that really lead the fashion game, which they are. Those were trends before it became trends in the rest of the United States. And then obviously the United States adopted it. And then it was interesting because she just pointed that out. And I was like, you know what? You're right. Like, where are all the leggings at? Where are all the Lululemon pants at? Like it's interesting seeing that. And like people were dressing different. And so I just wonder, could this be a phenomenon that then starts to affect the rest of the United States where the yoga pant look goes out over the next few years, right? I don't know. Like maybe that doesn't happen, but it's something that needs to be considered because it has been the trend for the last several years. Whether you're going to work, you wear the yoga pants, right? The Lululemons. Whether you're going to work out, you wear the Lululemons. Whether you're around your house, you wear the Lululemons. If that's a trend that goes out over the next 2, 3, 4, 5 years, it'd be very detrimental to Lululemon's business model. And then if you tack on more competition in the market as well, that'd be a problem as well, right? And keep in mind, you know, people sometimes when they see like what's going on in front of them, they think that's going to last forever. Like there used to be a time when everybody wore jeans. Like if a guy went to play tennis, he wore jeans. Like it's crazy to think now, like what the heck? But yeah, like people wore jeans all the time. They wore jeans around the house. They wore jeans everywhere they went. They wore jeans for their work. Like that was the thing. And now it's you know obviously far less common. So I don't know. This is just something I think everybody out there should consider. And maybe there's something going on here, right? I don't know. We'll see. So Lululemon's a little bit, I would say Lululemon's a little bit scary right now. That's what I'd say about that. Celsius Holdings. So Celsius, new low, $37 here today. Stock's down 53, almost 54% the past 3 months. It's getting destroyed. So here's a problem with Celsius. We got some problems, okay? So first thing is, you know, if I looked at Celsius's forward P, I actually don't trust it. I don't trust it right now. I listened to a conference call, I think it was 3 times. 3 times I listened to that latest conference call from Celsius. And every time I listen to a conference call, especially the question and answer portion, I walked away less confident about what's actually going on in Celsius's business model right now. Every time. And so I don't trust that it might actually be a 39 forward P. And so that's why I need this stock lower. I need it at like a 35 or under forward P. I do trust that Monster is going to be roughly in line with kind of where they're at. They're just very good at kind of what they do and making sure they hit the numbers. But that Celsius conference call, maybe they were just off that day, but I did not walk away from that Celsius conference call feeling confident. I can tell you that. Especially, like I said, in the question and answer portion, it just seemed like it fell apart. It seemed like management didn't seem that confident. It was weird. It's very weird. And that leaves me to have trust issues about where these future numbers are going here. So for me, I need Celsius under 35. I have to have it under 35. If this baby goes under 35, I'm starting a position. There's no doubt in my mind. Like it's worth, the risk reward under 35 is worth it, right? And the lower it goes under 35, the more it's worth it, right? Like, let's say it went down to 30, okay, it's even more worth it. 25, 22, something like that, it'd be even more worth it. But I need it under 35 for me to start buying. When I was buying Monster back in the day, and that's a long time ago, it's over a decade ago, right? The forward P on Monster back then was in the 25 to like 33 range, if I recall. Somewhere around there. And that's way early days for Monster compared to obviously how big the company is now. And so I need Celsius somewhere around there roughly. Now, I could adopt a strategy here that I think would make me feel a lot safer in regards to this one. Let me address this, okay, before I, because I think this is a fair question as well, before I tell you about a strategy that I think would be ideal to kind of mitigate risk in regards to Celsius. What if I miss it? What if this baby goes to 40, 50, 60, 70, right? I think that's a fair question. I can deal with that. That's fine. That's fine. Like, you're not going to win them all. That's the cost of doing business in the stock market, right? At the end of the day, it's not just a game about reward. It's not just a game about risk, it's a game about risk reward. And so when I look at something like Celsius, I want to make sure I'm buying in an evaluation I feel okay at. If I'm buying the stock at 34 bucks, 32 bucks, 28 bucks, I'm okay with that. And if the stock goes down a bunch over the next few years and I miss on that, I'm okay with that. What I'm not okay is feeling like FOMO-y and feeling like I just got to buy it because I don't want to miss out on upside, right? Because there's so many stocks in the market. There's thousands of stocks in the market. The amount of companies and ticker symbols I have in this brain right here is ridiculous. There's so many companies and there's so many opportunities in the market. It's not like Celsius is the only opportunity, and if I miss that, I'm never going to make money in the market. No, there's a million opportunities, so many ways to make money in this market. So if I never get a position built and it just went 40, 50, 60, 70, sweet. Have fun, Celsius, like good. And if it comes down to my valuation, I build a position and make a bunch of money, then good as well. Like it's all gravy in the end. It's all gravy. There's too many opportunities to sweat out if you miss an opportunity. There's a lot of them, right? There's a lot of them. Now, here's a strategy that I could employ that might make me feel a lot safer in regards to Celsius. Because here's the deal. The risk is with Celsius, it's a one-trick pony. I don't really like investing in one-trick pony companies because it's risky, right? If that one brand is damaged in any substantial way or anything like that, like you're taking a big risk. So with Celsius, it is a one-trick pony. They got their Celsius brand. It's big. We all know it, right? But if that brand is damaged in any substantial way, if for any reason, it's going to reflect very poorly on the company. So what it could employ is a tactic where essentially Monster is decently attractive here, right? I could essentially, let's say I was thinking about putting $100,000 in Celsius. What I could do is put $50,000 in Monster and $50,000 in Celsius. So then, if I'm right about Celsius, I'm still going to get net upside, right? Which Celsius is a stock that I would feel like has a lot more upside over the next 5-10 years than Monster, because Monster's a much more mature company, right? But on the downside, if things really went south for Celsius, well, Monster's going to always hold up, right? They got too many brands that are very successful. The Monster line itself owns so many different products and brands, it's ridiculous. The Rain brand is huge. The Bang brand is huge, which they own Bang nowadays as well. And they own other brands as well. So I feel like that would be a better, safer way to play Celsius is to build out positions in both those, right? Sometimes you got to mitigate risk, and that could be a risk mitigating strategy. And I own 2 drink companies that are monsters, no pun intended. So I don't know. We'll see. We'll see what happens with that. There's one other thing I'm concerned about here, though. I got to be honest with you guys, and that is a situation where unemployment was to go up substantially. Because let's say that did happen over the next year. Let's say unemployment rate went up quite considerably over the next year. It's going to mean less interest drink sales. It just is. It's just, you got to understand, if the restaurant cuts hours, then doesn't need as many, if the restaurant's not doing as much in sales, right? It doesn't need as many busboys running around. It doesn't need as many cooks in the kitchen. And those busboys and those cooks in the kitchen, guess what? They drink Celsius. They drink Monster. If they don't need as many waiters and waitresses, it's not good. And those waiters and waitresses, a lot of them drink Monster and drink Celsius. If, the landscaping company doesn't quite have enough business next year, well, then those landscapers might not be drinking as much Monster, as much Celsius. And so this is just things you got to consider and the ramifications of that for those business models. And that's one thing that kind of gives me a little bit of pause in this, is kind of thinking like, what if we do go to 7% unemployment, 8%? What does that mean for those brands? And I know it would mean bad sales for a year or two, right? But those are the sorts of brands you can kind of feel good holding them long term too, right? So just a little food for thought in regards to that. Appreciate y'all joining me as always. If you're looking to become a much more serious investor than where you're at today, and you're looking to apply, join my private group, my private stock group, private wealth group, get access to 1000xstocks.com, take your game up to a much higher level than where you're at. Click the pinned comment down there, fill out an application. We'll see if we can get you access to all that next week. Much love and have a great day.